Good morning, everyone, and welcome to our DAT IQ weekly market update. This is our update for October 12th, 2021. I'm Ken Adamo, Chief of Analytics here at DAT, joined by Ned Damon, who's our Principal Data Scientist, and Dean Croak, who is our Principal Industry Analyst. Welcome, guys.
Hey.
Howdy.
Hey, Ned.
Back to the OG format today. No guests, focusing on the freight markets. How's that feel?
Yeah, fundamentals, lunch pail play, leave it all on the field.
That's right. I mean, it's a great week. I mean, if you look at like college football, half of the top AP top 10 or Big 10 teams, that's a great week to be a Midwest homer.
I'll say the people here in Oregon are, we're on tenterhooks over here.
I saw a picture of a Publix shelf, and they're seeing salt shortages. I assume that's all the Alabama fans salty about the A&M loss. I'll see myself out. So to kind of tee up the show this week, it seems like in the past week, the entire mainstream media apparatus has caught on to the fact that we're facing a global supply chain disruption. And if you're a fan of the show and a longtime viewer of the show, you'll know we've been talking about that for 18 months, right? So I think what we're going to focus on today as a theme is a lot of these outlets have taken the gloom and doom approach to these kind of things. But I would encourage, and I don't want to speak for Ned and Dean, but I think we would all encourage you to maybe step outside of the gloom and doom a bit, rely on the data, rely on your intuition, and get through this, right? There's no real way out of this. There's no magic bullet, but there's certainly a way through it. And the only real way through it is to use all the tools available to navigate through this peak season and come out as unscathed as you possibly can. So that's my really opening theme and message here. Let's dive into the key points of the week because there is a lot to talk about. All right, so key trends, essentially spot markets holding steady after that end of quarter, end of month blip, rounding out September, coming into October. Again, holding steady is a bit of an anomaly because typically we see a dip as that stuff is really hauled on contract capacity typically in the first part of October. Dry van reefer spot rates closed $1 a mile higher compared to last October, speaking to what I just mentioned. So the Class 8 truck orders are another really interesting thing. You're really starting to see the squeeze of parts, general manufacturing capacity. It was down 29% in September. Almost. That is not due to diminished demand by any means. And then, hey, it's fall. It's going to snow. First big snowstorm happening out west. Something to keep an eye on for those long cross-country hauls. With that, I'm going to turn it over to Dean to walk us through the market update. Dean?
Yeah, thanks, Ken. It's also National Farmers Day today. Just a shout out to all the hardworking farmers and ranchers who plough, sow and grow and harvest to feed our country. They also keep our trucks rolling. So special thanks to all you guys and girls out there. In the load board market, having a look at the load board load to truck ratio, dry van load post volumes were back 13% last week. Not surprising considering the week prior reflected end of month and end of quarter, as Ken mentioned. Equipment posts also increased, so the load to truck ratio last week decreased by about 20% from 7.10 to 5.64. In refrigerated load to truck section, capacity remains tight. Even though load post volumes dropped about 8% last week, equipment posts were up, so the net effect was the load to truck ratio decreased also, down by 13% to 12.54. Load to truck ratio for flatbed load post volumes are now 4 times higher than this time in 2018. It's an amazing statistic, even 60% higher than last year this time. Volumes have been up for the last 4 weeks in a row. Equipment posts were up also last week, so the load to truck ratio sitting about 54.98, long way south of the 110 that we recorded back in March, I think it was. Having a look at the market condition index, Ken touched on it, port congestion. It's been a story we've been talking about for months. Starting to show some interesting stats. The number of vessels at anchor are about 60. That's down from 73 on 9/15. Ships are still spending 4 to 5 days in port unloading. Average wait times about 11.1 days at anchor before they get alongside. So still lots of congestion. We're seeing good volume in truckload on that side, tight spot rates. In Los Angeles, we're up for the fourth week in a row to 333, excluding fuel, up 5 cents last week. On the major intermodal lane where truckload competes, Los Angeles to Chicago, loads moved were up another 5% last week, more than double this time last year. Rates are also up 16% year over year to 293, excluding fuel this week. On the opposite coast in New Jersey, Elizabeth, the port of New York and New Jersey, it's our number 2 port measured by import volume. Truckload volumes were down last week. Spot rates also down 2 cents. But on the busy lane to Chicago out of Elizabeth, they hit a new 12 months high. Spot rates were $2.29 a mile last week. That's 74 cents a mile higher than this time last year. In Harrisburg, capacity was also much tighter last week. Lots of e-commerce warehouse volume coming out of that market in particular. Average outbound rates were up 9 cents a mile last week to $2.78, excluding fuel. Having a look at the market conditions for the refrigerated sector, this time of the year we start to see meaningful volumes of produce from southern latitudes. We also start to see South American produce landing in Philadelphia, grapes from Peru in particular. We also start to see later this month the shift in produce volumes from Salinas to Yuma, Arizona for things like lettuce and other leafy greens, for example. So a bit of a shift underway right now as we head towards the end of fall harvest season. In Philadelphia, spot rates continue to climb, up 2 cents last week to an average of $2.97 and around $2.74 a mile, excluding fuel, for loads to Chicago. On that particular lane from Philly to Chicago, that's 95 cents a mile higher over this time last year. Philly to Boston hit a record high of $5.47. That's a 300-mile run. That's close to $1 a mile higher than the same week last year. Out west, the lane we talked about last week, Los Angeles to Las Vegas, up another 20% year over year to $6.19 a mile last week. That's $1 a mile higher year over year at $6.19, excluding fuel. Shippers are finding capacity tight in the Yakima Valley. No surprise there. For produce volumes are pretty good. Loads to Los Angeles up 40 cents a mile over the last month to an average of $2.33, and loads east from Yakima Valley to Hunts Point, New York, to the big produce market were up 7 cents a mile last week to an average of $2.99. Having a look at the flatbed market, lots of activity out of Albany, New York. It's a big inbound port for barge traffic up the Hudson River. Load post volumes spiked 48% last week. Shippers found capacity very tight for flatbeds. Rates were up 61 cents a mile to an average of $4.45, excluding fuel. Philly was a popular destination for those loads. Rates are averaging $4.30. That's up 16 cents a mile over the September average. Capacity was also tight in Jacksonville, Florida. Volumes are up 7% week over week. Spot rates are up 29 cents a mile to an average of $2.88. Capacity also eased, though, on that Jacksonville to Birmingham lane. It's a very busy lane for flatbed carriers. Rates dropped under the $2 a mile mark for the first time since April this year. Wrapping up with our year-over-year look at spot rates. Dry bed spot rates slowed last week. The rate of increase slowed, only increased by half a penny per mile. They ended at $2.54. Not a lot of change there. Compared to the same week last year, dry van rates are still 33 cents a mile higher and just under $1 a mile higher than the 10-year average for the first shipping week of October. Refrigerated year-over-year view, they increased another penny per mile last week. National average now stands at $2.87, excluding fuel. That's 50 cents a mile higher than this time last year and over $1 a mile, also higher than the 10-year average for the first shipping week of October. And wrapping up with our flatbed year-over-year view, capacity eased slightly last week. Rates dropped a cent per mile. National average is sitting around $2.65, excluding fuel. Still 40 cents a mile higher than the same week last year. Flatbed rates are even 17 cents a mile higher than the peak in June of 2018, which was the last major flatbed rate rally that we experienced. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download the long form version of today's weekly report. And that's it for the update. Over to you, Ned, for the short-term forecast.
Before we start doing the forecast, I want to put out a call for all you listeners to put in your questions. We love to hear from you. And at the tail end of the show, we'll be answering all of the listener questions that we can. So please get in your questions. The sooner is easier because it means we have a better chance of getting to your specific question. With that, on to the forecasts. One moment, my slideware isn't in the right place. Now it's in the right place. We're beginning with our Dry van forecast, you can see in blue the market rate observed by DAT, and then off to the right, there's a fair bit of model divergence. Ratecast is expecting seasonality to kind of reassert itself in the next week or so, expecting rates to drop by about 5 cents and then hold steady into the early part of November. In contrast, the short-term model is expecting the overall upward pressure to continue, heading up about 5 cents over that same period, and the two blended forecasts in gold and silver are holding in the middle. What's more, the Ratecast forecast is in green, the short-term forecast is in red, and the blended forecast, which are mixtures of those two forecasts in different amounts and in different ways, are in gold and silver. On next to our reefer forecast, here there's a lot more model agreement over what we're expecting to happen. In blue, we can see the spot rates observed by DAT. Off to the right, you can see a kind of mixture of colors because the short-term forecast in red, the Ratecast forecast in green, and the two blended forecasts in gold and silver are basically expecting rates to continue on a very slight upward trend, maybe up about 2 cents over the next month, but more or less holding steady. Finally, moving into the flatbed space, once more you can see in blue the market rates observed by DAT. These are at the national level. And then off to the right, you can see there's a little bit of model divergence, but overall pretty strong agreement. Short term in red expects a drop of about a penny or so heading in through the next month. The Ratecast model in green is expecting a little bit of a steeper drop, looking at about 5 cents over the next month or so, and then the two blended forecasts are leaning much more towards the Ratecast forecast here, expecting that rates are going to be dropping in the flatbed space, and those blended forecasts are in gold and silver. With that, we are done with the forecast, and it's on to our Ask IQ question of the week, which was prompted by a listener question that was emailed to our Ask IQ inbox, and that is, can you please go into detail about the greater Northeast freight market?
Do you want me to kick that off, Ned?
Yeah, by all means.
Yeah.
I don't know if there's anyone else more qualified on this your little program to talk about it, Dean.
Yeah, seeing I live here in the Northeast, been battling New England car drivers for the best part of 20 years. It's a whole nother market up here. It's predominantly a backhaul market for carriers. You know, I see a lot of carriers come down with loads of lumber out of Canada. We get a lot of lumber out of Quebec. A lot of those guys just turn and burn and head straight back empty. You'll see a lot of flatbeds running back empty, northbound in particular, especially as it gets towards the end of the week when the pickings are slim and they get close to running out of hours. There's a lot of carriers come in and run quickly back to bigger markets like New Jersey, Allentown, PA, which is where the question of the week came from. A lot of, most of the freight comes in. If you look at the inbound-outbound balance, there's about 11, in dry van that is, there's about 11% more loads come into the Northeast than go out. It's much more pronounced in refrigerated. In refrigerated, there's about 50% more loads go into the Northeast versus loads that go out. So you've got a big imbalance. It's essentially a backhaul market for dry van and refrigerated. There's not a lot of manufacturing that goes on in the Northeast, with the exception of Springfield, Mass, where there's some manufacturing. Not a lot of volume. There is some seafood that comes out of Gloucester, decent volumes there. They're loading about 30 trailers a day just north of me right now. But generally, it's an interesting market. A lot of carriers, and this is partly why I think the question of the week was asked, based out of Allentown, PA, and Harrisburg markets are huge warehouse markets. They're within a 500-mile one-day drive of about 90 million people. So if you wanted to locate your warehouses and your logistics operation and serve, 27% of the US population, Allentown is a great spot to do it. What that means is, though, you've got a lot of freight running, in the northeast direction, and not a lot coming back out. So it's essentially a backhaul market for carriers. Rates, though, reflect that. You've got a lot of inbound rates that are reflecting the round trip right now. If I look at dry van Allentown to Boston at $4.80 a mile, if you ran back empty, you're averaging $2.40 a mile, which is pretty respectable rates for a dry van carrier. A round trip of 616 miles is easily achieved in the 14-hour window. A lot of carriers do that. They just come in, unload, and go straight back. Refrigerated's the same. If you come in loaded at $5.72 a mile out of Allentown and run back empty, $2.86 a mile is your average round trip mile. So that's partly why you see inbound rates reflecting that premium, because of the imbalance in freight on the way back out. The other part of it is that carriers, drivers in particular, don't like the Northeast. A lot of fleets will pay drivers an extra 5 cents a mile to run into this part of the country, even additional money per load for loads into New York and Long Island. The physicality of the area, a lot of deadhead miles between load points. There's not a lot of truck stops. When you get north of the TA in Willington, Connecticut, which is the border of Connecticut and Massachusetts, there are very few truck stops that you can spend time in. So it's not an area that's conducive to spending time overnight. So a lot of drivers just prefer either not to run here, and if they do, they like to get out of here as fast as they can. That's the reality of the Northeast market right now. So that's kind of a bit of a summary. I'll throw it back to you guys for some additional insight.
Yeah, I mean, I think e-commerce has exacerbated a lot of these issues you mentioned, right? I mean, Harrisburg and that Wilkes-Barre, Scranton area, those were warehousing markets before e-commerce. I think it just became far exacerbated since then.
Right.
It's very congested through that corridor, like the Elizabeth, New Jersey area. I mean, those are all very, very highly congested areas of the country. And it's just not as easy. A lot of heavy toll behavior too, right? Which for brokers, that's something got to contemplate, right? If you have a newbie broker in a seat, you're trying to kind of negotiate over tolls, right? Let's just say that you don't have the software integration to correctly pull all the tolls in. You're sort of at the mercy of negotiating one-off. Tend to be a higher presence of motor carrier enforcement in the Northeast, right, Dean?
Oh, brutal. And Ken, $110 to cross the George Washington Bridge, and potholes that you could lose yourself in. Like it's a tough area, and it's hard to bypass. You can go, you can take 684 to 84 and try and bypass a lot of that New Jersey traffic up the I-90. It's just tough sledding no matter which road you take in New England, especially with traffic. I went down to PA over the weekend when I left late Friday night. It took 6 hours to do a 3-hour drive. And of course, we had a little bit of Columbus Day traffic in that, but that's not unusual to spend enormous amounts of time at a low average road speed, burning hours on your ELD, on your weekly numbers. It's just not an area that's conducive to good average road speeds and productivity.
I have a quick question. So you said that it's primarily consumer market, and that makes sense that there's a lot of inbound freight because you have so many cities and there's such a population density. But Elizabeth, New Jersey is one of the busiest ports, and Baltimore, I mean, it's not quite in that same zone, but it's within knocking distance, and that's a pretty active port. But is it just that most of the freight coming out of there gets consumed internally, and it's not moving farther afield?
In my analysis, sort of the preamble there, that's mostly New England. So I should have prefaced that by saying that's Connecticut, Rhode Island, New Hampshire, Maine, Massachusetts. Not so much that New Jersey market. A lot of that, I can't remember the exact stat, but the vast majority of containers that come off the ships land in a small footprint of warehouses. That's not very big, just in New Jersey. So there's a heavy concentration of there for, obviously distribution into that New York City market.
Anything else, or do we want to move on to some listener questions, or some additional listener questions that I should say?
Yeah, drop some more questions in if you have them in the comment section below. We have a few teed up here, but if you want to drop some more in, we'll stay a little long and answer them.
Okay. We have a question from Gary Bates. Do you see rates going up if brokers start filing for bankruptcy? Assumption he's adding that carriers need to recover losses.
I'm not sure where you're coming from, Gary. This is probably the most prolific year for carriers in the last 25 years. I don't suspect you would have to, I assume, be grossly mismanaging your business as a carrier if you're teetering on bankruptcy at the moment. Your profits should be up.
But he's asking about brokers rather than carriers in bankruptcy.
Carriers need to recover losses. I guess that's
but the prior part is, do you see rates going up if brokers start filing for bankruptcy? So there might be a thinko there, but
sure. It's going to be the most prolific year for brokers in the last 25 years. So their percent margin, I would suspect, is down, but their gross margin dollars based on volume is up significantly, right? So I think that's generally pretty across the board. I don't know. Have you guys seen something different? Am I just kind of tone deaf to what's happening?
No, I think you're spot on, Ken. I mean, I ran the numbers in my operating spreadsheet this morning, and for long-haul carriers in particular, even though diesel's up $1.09 year over year, rates are up about 31 cents a mile. So profit margins have never been better. I mean, the revenue gain from increased revenue is double the cost of higher fuel. There's carriers are still running fuel as a percentage of revenue around 23 cents a mile. Operating costs have only gone up 17 cents a mile because of higher fuel costs. So still making good profit. Around 70 cents per mile is the gross profit margin per mile versus 60 cents a mile this time last year. As we had, a couple of weeks ago, we had Todd Amon from ATBS on the show. I think the number was something like carriers in his network, the owner-operator group, were averaging around $70,000 a year gross profit. So I think it's been a great year for carriers, in particular in that long-haul sector.
Yeah, like I mentioned, the revenue per shipment the gross profit per shipment may be down for brokers, but they're moving 40% more shipments, right? So, I mean, I think it's evening out to more gross margin dollars. Now,
right,
for some of these modern digital brokers, right, that they weren't making money before COVID, and their sort of strategy was to undercut market prices to gain volume, I would suspect they're still probably in the same boat. But I'm not really sure. I mean, we would have no way to, if they're not publicly traded, we would have no real way of peeking at what they're doing.
Bohan, pardon for interrupting. Boyan, I'm not going to take a bash at the last name, is interested in our prediction for 2020.
2022?
2022, thank you. Yes, sorry. I forget what year it is sometimes.
So, I mean, I'll take a crack at it, just kind of to jump on the grenade a bit. I'm a bit unchanged in my philosophy for 22, which is eventually we will see normalization of the capacity. These Class 8 truck orders at some point will hopefully be delivered. I mean, let's just face it. If we don't see Class 8 truck orders, if we don't see things start to right size sometime in 22, I think we're talking about larger systemic economic issues, right? Yeah. I mean, the term collapse comes into mind, right? If we're 12 to 18 months into major stock parts delivery, industrial capacity shortages, that in and of itself is a major, major recessionary pressure. So, absent that, let's assume that doesn't happen for a minute. I think sometime in late Q1, Q2, you'll start to see these things roll off the line, the back order of Class 8 trucks. Now, to the extent to which it's prolonged, the extent to which the shortage is prolonged, you're digging a hole that you eventually have to put more dirt into, to borrow that analogy. Right. So yeah, it could push into Q2, but those trucks will hit the road. Hopefully we'll have drivers in those trucks, and then you'll start to see things normalize at some point. Right. Middle of next year would be my...
I'm just going to put one little bit of a wrinkle on that, and I think that like you said, things are either going to normalize or they aren't. And if they aren't, then that's a really bad situation. But normalize doesn't mean necessarily that the rates are going to go back exactly to where they were before. Like there's been a pretty big bump of inflation. Driver pay increases have happened. I don't think that rates are going to go exactly where they were before, pre-COVID, pre-everything. You're going to adjust upwards a little bit because of the way that, the world has changed.
Well, I mean, my advice to listeners would be to kind of think about it in two main branches of scenarios. So, I mean, everyone that has a business of any material size should be doing scenario planning, right? And I'm sure they are, high, medium, low cases. But I would kind of add a fork at the very top of your funnel. And that fork goes down two paths. Non-total economic collapse of the United States economy and total economic collapse of the United States economy.
Right.
So I would think about those through two lenses, right? Because if we have genuine a la 2008, 2009 collapse of the economy, all bets are off. Rates could go below where they were in 2019. Who knows? Yeah. Right? You would think, right? The only thing the Fed has trouble dealing with is deflation. They know how to deal with inflation, supposedly, to the extent that the government knows how to deal with anything effectively anymore. But we'll see. I mean, I think I'm not an economist, and no one on this show is, right? But I would assess the possibility of total economic collapse as non-trivial at the moment, to borrow one of Ned's favorite terms, unless you guys disagree with that.
I think it's more realistic than, like, if there are sustained ongoing supply shortages for a long period of time, like that's really rough. But yeah, like you also can't really play around that. So like you have to have it in the back of your mind, but you can't. There's no line there, right? Like if everything goes crazy, you're not going to outsmart everything that's going to happen, probably, unless Anyway.
Yeah, I mean, the modern freight market hasn't dealt with inflation above minimal, negligible levels in the last 10 years. So how the market responds to that, how it responds to these prolonged stock shortages. I mean, I kind of joked about salt at the beginning of the show, but I mean, literally, if we're experiencing salt shortages, that's not like shortage of treadmills or Pelotons at the beginning of the pandemic. That's a whole different ball of wax.
Yeah.
So, yeah. That's my prediction for 22.
Hopefully things will go back.
It's an election year too, right? It's a midterm election year. I mean, there's going to be a lot of volatility. I think it's foolish to assume that 22 becomes the year of tranquility.
Yeah.
Just plan for it.
Amin Radman says, I have over 5,000 carriers and we can't find loads for them. Why is everyone saying there is a shortage of drivers?
Wow.
I don't know if it's like Hot Take Tuesday, but if you come to DAT, we're experiencing all-time record load posts. So I promise you we have enough freight for your 5,000 carriers, and you don't have to look very hard to find it. I don't. I mean, unless you're searching like Hawaii to California trucking, I don't understand where you're not finding loads. Give us a call, right, if you need help. One of we have an excellent customer service team. We just celebrated Customer Service Week last week. These folks are excellent. They can help you with some product training, but you should be able to kind of frolic in the meadow of the load board and be awash with freight. And I think if you told any broker in America right now that you had 5,000 carriers looking for freight, you would have a line of suitors down the road.
Yep.
So reach out to us. We're more than happy to help you find some freight.
Mark McDaniel says, will outbound California rates cool off in 2022? I feel like we kind of covered that.
California is a different animal, though. Dean, what's the latest projection on when we're going to see normalization of Southern California ports?
At least 6 months is when you talk to Lars Jensen, who's the sort of the ocean expert at marine intelligence, at least 6 months of activity where before you start to see things return to normal on the port side, on the ocean side. And that's driving spot rates and volumes at the moment.
Yeah, I genuinely think the California normalization will lag national by at least a quarter, would be my guess. Educated guess. But we'll see.
Yeah.
I think for all the reasons stated, ports, the nearshore warehousing stuff, the intermodal capacity, I mean, that all has to, several dominoes have to fall. It's not just like a market like Chicago where they're dealing with a couple problems that can resolve themselves rather quickly. It's a much more, it's a much more compounded issue.
Yep.
Elisha Ayers, is Ned related to Matt Damon? Can you guys see me in Goodwill Hunting? Not that I know of. Thank you for saying so, Elisha, though. Trace Rosenberg, have you heard about truck manufacturers canceling orders for customers and then asking them if they want to reorder at a 15% higher rate and at a much later date?
No.
I mean,
I've heard of it. I haven't seen the emails, right? I haven't seen the smoking gun emails of this happening, but we've definitely heard chatter of pushing off the order books in 22 because they frankly don't. There was like one public statement that came out that said like the reason that 22 order books are lagging is unknown, like the unknown around parts availability, but also like OEM struggling where to set their prices. I haven't necessarily seen a ton of evidence, if any, that they're canceling orders and making them re-up. But that'd be interesting. If you have any, send it in. We're happy to talk about it in the next show.
Right.
Yeah.
And Dean has pretty good relationships with a lot of industry folks. He can kind of chase that to ground. Sure. I don't want to volunteer him for work, but.
But you just did. Jay Stanton, Utah is the leading salt producer in the United States. How is there a salt shortage? I think not to go too deep into this, but I think a lot of the problems isn't necessarily with like the sourcing of the raw materials for a lot of this stuff. It's with the supply chain. It's with like the manufacturing and the packaging, and like it's not necessarily the raw goods themselves. It's getting them into the right place at the right time for the folks who need them. You guys have?
Yeah, I do. It's a great example because the packaging thing is pretty close to home for us. My wife's catering business has a shortage of 32 and 16 ounce plastic containers. They cannot buy plastic containers to store food in anywhere here in New England. But last month there was a shortage of plastic plates and cutlery. So when you think about packaging, you've got a shortage of packaging to package up the salt. That will impact the supply chain, and I suspect that's what's happening.
Well, there's also like shipping it too. I mean, I love the salt example because there's no shortage of salt, but most people aren't driving to Utah to scoop it up for themselves and bring it home, right? I mean, you're relying on the supply chain to package it and bring it to you. And I was just at Costco, and like I thought some of the pictures online were almost like a joke, but there's a lot of like mismatched packaging. So I thought the funniest example, and I forgot to snap a picture of it, was if you're familiar with saffron, it's like I don't know, $8 or $10 for two or three little. What are they? The stamen of the flower?
Yeah,
I don't know. Like the little inside of a flower, and you use it for rice or whatever. They had it in those big, that you put like salt or garlic powder or parsley in the commercial size tubs. There was this thing about this big with like a little baggie at the bottom and some saffron in it, like probably no more than a gram. Right. They're struggling. I've seen a lot of alternate packaging out there. Now they're getting what they can. A lot of restaurants, right, that like the simple things like straws should be done in single serve. They bring you to your table, they pull it out of their little belt, they give you 4 individually wrapped straws. I'm seeing more and more like bulk packaging that they're resorting to because they can't get to individually packed and wrapped stuff. Right. So that's happening a lot more often, and it's just due to these sporadic shortages that we're seeing.
Yeah. I mean, it's not entirely, but it's largely just this knock-on weirdness in the supply chain. It's not that there's a shortage of raw materials.
Yeah, and I mean, the supply chain encompasses everything, right? So it encompasses like the sourcing of the materials, the warehousing of the materials, the actual manufacture of the product. It's kind of like, it's a gap, but it's a step, right? We don't think much about manufacturing. We're thinking about the supply chain. It's an operation that happens in the supply chain. And then it's post-manufacturing, warehoused, shipped, forward stocked, shelved, sold, brought home. That's like the entirety of the supply chain. Mm-hmm. So whether it's salt, all the spices, right? I mean, we had a long thread joking about getting your sage for your Thanksgiving turkey and stuffing, right? Yeah. McCormick came out with a announcement that they're going to have a nationwide spice shortage. So, again, it's not just exercise equipment or toilet paper or paper towels or bottled water that we always sort of half-heartedly joke about.
It's entirely just a promotional gimmick for Dune, Ken. all the spice, it's gone. Sorry. Joking a little too much. Amani Redmond has another question. Already touched on this a bit, but what are your thoughts on the containers stuck at the ports?
Yeah, I mean, it's a huge issue. It's going to take a while for those 60 containers. They run about, the average is about 28 containers at berth every day. They're sitting 4 to 5 days on the West Coast on average. There's about 60 backed up. It's going to take well past Christmas before this starts to ease. We've got 26, I counted yesterday, off Savannah, which is kind of unprecedented. It is easing, though. I mean, I concur with Ken's comments early in the show. We don't see the doom and gloom that mainstream media is just finally caught up to. This will clear pretty quickly. I think there's a big shift, though. We've got consumer channel shift. We've got a lot more consumption of goods online versus bricks and mortar. So part of the reason you're seeing such freight imbalance is that we're still buying more and more online and less in bricks and mortar stores. So that's causing a truckload imbalance. So I think it's going to take a while for that to clear on the ports. It's going to take a while for chassis trailers to get back where they need to be to get in their cycle. And it's also going to take shippers a little while to unload all of this freight that they've got at their warehouses. I don't see much easing in that this side of Christmas, certainly.
Yeah.
No, I mean, again, we've talked about it on the show prior that, we're seeing break bulk ships come in with 153 footers sitting on top, which were chartered by large national carriers on behalf of their customers. Right. So, I mean, again, when we're to a point where the pressure release valve is chartering entire vessels full of containers, that is a backup to a backup to a contingency to a backup to a contingency to a holy crap plan. It's like those are like, what they teach in college that you're never actually going to use. It's like, well, what happens if the entire global supply chain melts down? Well, we'll charter boats full of freight, of just our freight for hundreds of thousands of dollars from Asia. We'll bring it here. We'll pay 5x the normal price to dray it. We'll transload it in an abandoned Kmart parking lot, and then we'll pay 100% more to truck it to its final destination and hope it gets on the shelf in time for the holidays. I'd love to see who wrote that research paper 10 years ago in like Supply Chain 101, right? But all right, I think with that, or anything else?
We have one more question, if that's all right.
Yeah.
Ecologistics asks, thank you for all the work you do to provide updates. Can we look at detailed information on the dry van market in the Central South next week? I don't know about next week, but I mean, yeah.
Well, Alex will be, so I won't be here next week. I'll be traveling to Denver. It might be something we could, I mean, can you define, maybe just drop it in the comments so we have a record of it, what you consider the Central South?
What markets? Yep.
Yeah, like what states even?
Lanes. Yep.
Central South to me speaks like Texas and its surrounding neighbors, but you could be talking about like Arkansas, Georgia, Mississippi. So just be more specific, and I think we can absolutely, well, again, speaking for work, I won't be doing. I'll be on an airplane.
We'll do it.
All right. So with that, I'm going to wrap us up. Couple things. So our own Chris Kaplis, Dr. Chris Kaplis, was on Fox and Bloomberg yesterday talking about all of this turmoil, keeping a very level-headed analytical approach. I love it. Not giving in to sensationalism. Rise above. So that was good. I highly recommend you check it out. I'm sure you can go view it on one of their outlets. Dean has, can you touch on your Sirius XM stuff?
I'll be on Sirius XM Road Dog 146, 7 p.m. Eastern tomorrow night on Landline Now. That's Wednesday. And then Thursday morning at 8 a.m. on Radio Nemo.
Again, highly recommend checking that out. It's full of good stuff, kind of more long form industry stuff, things we can't touch on as much here. We'll be at TIA. We'll have a presence there. That's down in San Antonio in a couple of weeks. And I think that's all. I highly recommend checking out the past couple shows we have recorded up on the interwebs there. Andrew Silver from Molo, still picking apart that interview with all the great stuff he talks very fast, so it's taken me a week to kind of part it all out. But I love the comment about this isn't an exit, it's an entrance. I thought it was a bold. And then Tim Gagnon 2 weeks ago from C.H. Robinson talking about market rate IQ. Those are really good ones if you're catching up. But with that, we'll sign off. I'll see everyone in 2 weeks. But we'll see you here next week. Ned and Dean will, at least. We really appreciate you tuning in and hope you have a great rest of your week. Bye, everyone.
Bye, everyone.
Bye.